everyone. It's really great to see a packed room today full of familiar faces. For those who don't know me, my name is Helena Anti, and I'm Head of Trading at the JSE. It gives me great pleasure to facilitate this panel this morning to discuss basically the factors that's driving growth in our country, as well as to look at reforms that is needed to promote further growth as well as drive innovation in South Africa. So I am joined by Alicia, Ben, and Ovation, my esteemed panelists, for this hopefully very insightful discussion. And before we delve into the question, I thought it would be, when we talk about growth, the one thing that comes to mind is ETFs and AMCs, not just locally, but globally. So I thought I'll just start off by sharing some stats about the growth of ETF, not just locally, but globally, just to set up the tone for the discussion this morning. So looking at the global view, first of all, the left side just shows global flows, and then the right axis shows total assets under management of global ETF. So last year, global ETF flows reached a record of $1.5 trillion, with assets touching almost $14 trillion. And both equity and fixed income funds captured 95% of those and had record flows as well. And if we look at the split of those flows, unsurprisingly, the US captured or dominated 75% of both those flows as well as those assets. And if we look at the US domicile funds, post the November election, almost $300 billion flowed into those funds in the last 2 months of the year, so very impressive. Similarly, that being said, funds outside the US as well reached record flows last year, totaling $377 billion, which represents a 13% year-on-year increase. And an interesting fact to note is that global flows into actively managed ETF doubled year-on-year last year, reaching almost $340 billion. I don't know, oh yeah, thank you. So looking at the SA landscape, SA historically has always followed the global trend. And in the last 10 years, the number of listings in South Africa has tripled as well. So last year, we also had a record flow, and total asset touched almost $200 billion, with a whopping 34% year-on-year change. And interesting, global equity and commodities were the biggest factors of this flow. In terms of the listing stats, we had 18 actively managed ETFs in terms of new listing last year, bringing the total listing to 25, and we had 7 ETF new listing last year, bringing the total to 118. Next slide, please. And then AMC also had similar trend with a tremendous growth last year, record flows, and total AUM doubled last year from 10 the prior year to 20 billion. And we had 16 new actively managed certificates and 7 actively managed loads that were listed in 2024. So just to contextualize all these stats, if we look at the US, the split is 50% mutual fund and 50% ETF. And Europe have been catching up in the last couple of years and is now currently sitting at 20% ETF in terms of asset management. And South Africa, in comparison, we're now sitting around 5% in ETF out of the total asset under management. So along this tone, Ben, maybe I will just start with you. If you could just give us some color in terms of what are the drivers behind the growth in ETF and the adoption trends that we've seen.
Sure. I just want to we'll talk about the drivers. When we look at the ETF growth, I prefer to look at the European market as opposed to the US market, for the simple reason there's a specific tax arbitrage in the US market where it's favorable treatment for ETFs as opposed to mutual funds in the US. And that skews the numbers a little bit. But so the European numbers with that, I think you mentioned 25%, that is sort of a more realistic number of what one should look at. But having said that, it's not a bad thing if you have a regulatory lever that pushes growth in a market, because you have movement towards ETF, and then the use case of ETFs is better understood. because now you've got more funds out there. And that doesn't just speak about ETFs, it speaks about listed products, listed wrappers. We'll chat about the AMCs now as well. And once the use case is better understood, you'll have more trading, and that is what you find actually now it's happening in Europe, and look, ETFs used to be just index trackers. Now you have active managed ETFs as well, and you see massive growth in Europe. Although, the uptake in ETFs in South Africa, the numbers are impressive, but it's a very low base. And you've mentioned the 5% uptake versus the 20%. It's interesting that we had ETFs in South Africa before they had ETFs in Europe. So we're lagging the world by a long shot, by a long way. Now, the reasons for that is multiple. The use case of ETFs in South Africa is not that well understood. You only had index trackers, which was sort of modeled as passive investments. South African market is dominated by active managers. So you're not going to embrace ETFs if it's a passive investment, if you're an active manager, right? So, but now with actively managed ETFs being allowed, now suddenly it opens the door for active managers to bring funds to market. Now if you're an issuer of funds, Coronation, big asset manager, listed 8 funds on the Prescient Conan platform recently. Now suddenly you have to focus on, what's the use case? What is the, what can we do with ETFs, right? So now what is that use case? What is the drivers? Now there's 3 distinct drivers that's growing actively managed ETFs, and that will benefit the index trackers as well, because I speak about the use case of ETFs. Now the first driver is one word's convenience, right? Now, it's always been around, but for good reason, not being exploited by active managers. So we have a lot of clients that's approaching Prescient from the wealth management space, where they have, on BDA, managing model portfolio for multiple clients, and they're discretionary managers. Now, to manage a model portfolio for 50 clients, you have to rebalance across those 50 clients. It's operational nightmare, right? Now you can take that same portfolio and you can wrap it into active managed ETF. You still manage the portfolio and you still have it on BDA, and now the thing can freely trade in the market, very easy entry point, exit point for the investors. And that is a big driver that you could obviously not have when you just have index trackers, because wealth managers not going to manage the index tracker, because where's your value at? Second big driver, and this is where there's a regulatory lever, is on the exchange control. From exchange control perspective, since 2005, you can argue there's been uneven treatment between ETFs and unit trusts, because index tracking ETFs that reference foreign assets are treated on the SA market. They're treated as foreign investments on the SA markets, but it is dispensation for retail investors to invest as much as they can in those ETFs, and there's no limit on the management company that issues those ETFs, right? Or what they can take offshore. Why is that? It's for the simple reason that the money always comes back, right? Because the exchange control regulation is quite clear. You can only issue those ETFs in rand, and you can only trade them and settle them in rand. So now that creates an opportunity for certain asset managers that might be at the cap, that they can't take more assets offshore as part of the 45% cap. Now you can, take the same portfolio and you can wrap it in an ETF. So is that a good thing or a bad thing? Well, the thing is those assets are still classified as foreign assets. So where the big money is from a prudential perspective, prudential asset allocation perspective, there's no additional outflows. Its only benefit is from retail wealth trust money, that they have no limits invested in that. So it doesn't have a massive impact on the balance of payment, and that's also been shown, with the index trackers over the years. But now the playing fields is now level, right? So, and then the third driver that we see in the ETF space is that for income funds, you'll see most of your newer active managed ETFs that's coming to the market is income funds, and that really speaks to the use case of ETFs. Now traditionally income managers in South Africa will outperform most sort of money market indices and that sort of thing. So you can get a better performance in an income fund than you have in a money market investment. So where do the clients park their cash? And I talk about the wealth management space, and that's also actually been taken up by institutional investors as well, where you can trade your equity, whatever you trade on the JSE. If you sell your NASPAT, what do you do with that cash? You buy an income provider, there's a portfolio metrics income fund, there's the present income provider that you can buy. There's multiple of those income funds that you can buy. So you sell the equity, you buy the income fund, and you get a slight yield pickup return on that side. But those trades have been happening in Europe the last 15 years. It's never been properly embraced in South Africa for the reason I said that ETFs hasn't been embraced by the active managers. But that's the three drivers that we see at the moment. Now, for ETFs really to grow and really to have the benefit, we want to be in the space where Europe is. We have multiple funds, because if you have multiple funds, then it becomes easier for multi-managers to buy the ETF equivalent as opposed to the unit trust equivalent, right? Then the whole distribution argument or discussion becomes easier, because currently you access unit trust via LISPs, and there's a huge universe. All the unit trust sits on LISP, so you've got a very small universe of funds on the JSE. So the distribution argument is not strong yet, because the universe is small. But these three drivers that I spoke about will create the bigger universe. And once you have the bigger universe, the distribution will become more obvious. Once the distribution becomes more obvious, the use case becomes obvious, and institutional investors start embracing and using these ETFs. So I think we at that point where finally South Africa will catch up with the rest of the world on the use of ETFs and the growth of ETFs. So I think it's exciting times, and that obviously leads to more liquidity on the JSE as well.
Yeah. Now we're very excited to see how the year pans out and more listing, as you mentioned. So moving on to your Avation, obviously you've had extensive experience in AMCs, and we've seen the growth last year, but it's still a low base, relatively speaking. So we'd love to hear your thoughts on the constraints that's hindering further growth in that segment, and what potential reforms that's needed to really see that segment take off.
Okay, excellent. Thanks, Helena, for that question. I think in sort of trying to give a holistic answer to what are the constraints, I sort of summarized it in 5 points, which I thought were useful. Some have regulatory nuances, some have exchange or platform nuances, and then some have investor-issuer nuances. And I think if we use that as sort of 3 themes, then you've got a good way to look at what are some of the hindrances. I think with respect to an actively managed solution, you've actually got 2 mechanisms in which you can provide that. So Ben's covered the fund route, and I think that's very well regulated both globally as well as in South Africa. And yeah, certificate route has the alternative of actually just being a debt security. And that introduces some complexity from a regulatory perspective, because your considerations are quite different. And I think that is something to give consideration to, where can we copy what's happening around the world? And if you look at the US, for example, and Ben mentioned this point, ETFs have grown significantly. I think it's a huge part of the market. Europe, I think, is a balance between structured product issuers and ETFs, Whereas Asia is at the extreme, where it's very much product-focused, ultimately taking on the credit risk of the issuer and having different payoffs that are applicable. So you probably need to take pieces of these different regions and then define what you want in the South African market. I think that then leads to the next point, which you and I were chatting about, was investor education. And I think if we think about that, I actually think that's the wrong way to position the problem statement. I don't think investors need the education. I don't think the fund managers need the education. I don't think the brokers need it. I think financial advisors and then fund trustees are sort of the two areas where we have to actually focus our efforts, because those are the two sort of pillars that I've identified that you really have to get them over the line to then start to develop your product set. And that's where I think we actually have to focus our energy. And, if we look globally, there are actually both exchanges and even issuers that partner to develop education initiatives. So if we look at the Hong Kong Stock Exchange, they work with issuers in putting together purely online-based education platform. People can log in, get access to different pieces of information to take them on that product journey. In the US, it's done a little bit more by the regulator, and I think similar in Europe. So you then have to look at how you can develop these partnerships, and I think that's where the issuers play a big role in partnering with the exchange as a platform. So sort of putting those two themes aside, I think the third area to then look at is really who's at the center of all of this. And this is where the investor, their protection becomes quite key. And one of the key things there is really about, I think, transparency, liquidity. If you're coming from a bank perspective, then we'll call it risk management. What are some of the market-making obligations? What are some of the disclosure requirements? Where you actually put the investor at sort of the center and define a number of spokes around this that people need to contribute to. And then I think it clearly lays out the task of different counterparties in that whole process to what they need to bring to the party. So unfortunately, it's not as easy as saying, these are the 5 things, let's go ahead and solve them. It's a bit more of a multifaceted problem, but I think there are ways where we can leverage different parts of what's happening globally, and I think also the success that we've had in South Africa to drive the growth of this product market a little bit.
Yeah. So learn from global, take the pieces that work and collectively work together to, whether it's from education or whatever, just to drive the product forward. Great. I will just change the topic a little bit to move to Alicia and talk about digital assets. So in October 2021, the US approved funds that could hold futures contract on Bitcoin. And last year, January, obviously, SEC approved the first physically backed ETF, and it was one of the most successful ETF in history. And collectively, the 12 spot Bitcoin ETF have passed more than 100 billion in asset management. So it just speaks of the popularity of the product, even though Bitcoin has had a bit of a selling rod lately. But so Alicia, moving on to you, how is the JSE preparing for digital assets? And what are the infrastructure consideration that needs to be considered for that to be effectively implemented?
Yeah, thanks, Elena. I'll take a little bit of context before I get to the JSE's activities in the space. I Googled this morning, Bitcoin has been around for 15 years now. So I think I was quite surprised to see that stat. The first trade was executed in 2009. And the growth since then has been absolutely phenomenal. And certainly even in the past year, we've really seen digital assets pick up for a variety of reasons. But, Bitcoin was up 140% last year and is now sitting at a $2 trillion market cap. And that's just one of many other digital assets, although obviously an important one. And originally, the trading in these types of instruments was more retail focused, but as you've mentioned now, we're seeing more and more institutional interest, confidence to dabble in these instruments, and we're seeing a shift in the investor base in these types of instruments. Crypto ETFs, very impressive growth over the past year as well. As you mentioned, it's been only 12 months that the first US crypto ETF has started trading following the SEC's approval last year. And the top 5 today, ETFs in the States, make up 70 billion. They have 70 billion market cap, which is a big number to accumulate in only 1 year. Some of them are returning 35 to 40% after having just started out 12 months ago. So that's particularly important and particularly impressive, and I think a real trend that we want to get onto as well as a South African marketplace. And of course, growth is expected to escalate even more in 2025. Enter stage right, Trump administration. Trump has been extremely aggressive in his support of these types of markets. He's made very many public statements about them. He even launched a meme coin during his electioneering, so he's into it. And frankly, he got the SEC chairman fired, or I mean, the guy stepped down before he could be fired. But you know, those were threats from Trump himself. And what does this mean? It means that we should expect a broad opening up of regulation, frameworks, legislation, particularly in the US, driving and promoting these markets even more than we have seen in the last 2 to 3 years. We have seen a number of lawsuits that the SEC had with various providers in this space actually being dropped. And this week, it looks as if they're dropping a lawsuit that they've opened up against Coinbase for some of the activities that the SEC was in disagreement with. So there's sort of I don't know if it's quite 180,
shift.
but it's a very big shift in the US landscape around digital assets and specifically the crypto ETFs as we're talking about here. But what are the benefits of crypto ETFs? I mean, really what it enables is investors to access digital assets without holding the underlying directly, which is often a very risky product. So it gives you accessibility, it gives you a mechanism to actually diversify your portfolio and get some of these assets onto your book and start dabbling in this space. I think secondly, it's technically, if you take the regulatory technicalities out of the way, technically quite simple to launch and trade these instruments. We can do it on our traditional platforms. We don't need to build anything from a tech perspective. We don't need new tech integration. Investors and traders don't need to build anything on their side. We can use our existing platforms for our traditional markets to list and trade these instruments, obviously once the regulatory hurdles have been achieved. And thirdly, what's attractive about them? They're earning very good returns. So that's the evidence over the past year. I mean, I think nobody's going to say no thanks to a 40% return.
They're very risky.
Well, yes, return and risk go hand in hand, don't they, Ben? So what are the regulatory concerns for these types of instruments, and where is South Africa in that context? Because that really, right now, is what our biggest hurdle is that we need to overcome to be able to list and trade these instruments here. Regulators globally have all been grappling with these particular issues. I think some of them are more advanced than others in sort of chipping away at how they might address them. I'm particularly impressed with the Singaporeans, for example. I think they have a very open regulatory approach to how they would deal with these instruments. But obviously they're worried about having to oversee instruments that are different from the traditional instruments. How do they oversee them? Do they have control over the underlying? The entities themselves that need to be regulated here are not the traditional players. They are players that have platforms that are unique, that are different, can differ one from the other. They might not even be located here. You know, so when we talk about regulatory equivalence and so on, that all becomes very tricky in terms of how do you actually just deal with these strange instruments and these strange players. I think more deeply than that, there's also a concern around the convergence of the digital and the traditional markets and instruments, and how does that impact monetary policy? How will that potentially play out? It might be simple to think about it when one is still very low in concentration, but as that grows and you have an evening out, What is the time frame for that to happen, and what does it mean? And then I think for these instruments in particular, as been commented to me now, is they are risky. Extreme price volatility. You can obviously lose a lot of money if you make some of the wrong moves. Liquidity is also tricky at times. So when you have a market stress, do you feel confident, or will the regulator feel confident that there's enough liquidity to get yourself out of that stress situation? So really there are many elements from a reg perspective that all the regulators are dealing with, and struggling, I think, to get this balance of risk and reward right, because at the end of the day, the ultimate objective would be stability and investor protection. So in South Africa, where are our regulators on this issue? Of course, they've been working on various elements of the puzzle. We wish it went a little bit faster, but I think it is a tricky problem to solve. Both the FSCA and the PA have been reviewing many of our regulatory frameworks and principles and rules to check how can we incorporate the digital assets into either our existing policies, frameworks, and rules, or do they require their own bespoke and parallel rules. They have classified these instruments as financial instruments, which means that they then can be sort of controlled and overseen by the FSCA itself as opposed to be left on their own. They've obviously been approving CASP licenses, so those are crypto, I forget what the A stands for, service providers, crypto asset service providers. I think there are around 250 of those that are approved as we stand now. So again, that gives the FSCA some control and mechanism to monitor what's going on there. And there are a number of experiments going on. I think many of us in this room have been involved with things like CORCA, where we've done interbank settlements using the blockchain infrastructure. We've done equity trade settlements through that same infrastructure, and I believe now they are working on using digital rands or CBDCs to do retail transactioning. And those experiments obviously are being driven by the regulator to help inform them how the regulatory frameworks might be adopted and changed to address that. Where's the JSE in all of this? That was your original question. Sorry, I took the long path to get to it. We are working on frameworks, regulatory frameworks, listing frameworks to enable the listing of crypto ETFs on our traditional platforms. That theoretically is a quick win. We've got some really great benchmarks and case studies out there led by real giants in the industry, led by big markets and big regulators that our own regulators look up to. We have defined such a framework, and we are currently in discussion with the FSCA and the PA to get them over the line, to give them the comfort that we have some mechanisms by which we can manage those risks that they are concerned about. And fingers crossed, we would really be excited to get those over the line during the course of 2025. I think it's possible. I think the regulator is open to it, but of course it's not entirely in our hands. So really that is our highest priority insofar as these digital assets go, and I think that the market would look to that very favorably. In parallel, and of perhaps a lower priority, but still something that we are very eager on, is to establish a bona fide digital exchange on a blockchain infrastructure set where we can trade not just ETFs and derivative instruments, but a full spectrum of digital instruments, whether they be tokenized real-world assets, funds, whether they be spot cryptos. Once you've got that infrastructure in place, you can actually trade quite a wide range of different instruments. So that's something we're pursuing as well.
Very exciting indeed. Ben, if we could just move to you. Do you want to add something? Absolutely, go for it.
Yeah, I've got a question or a comment, Julish, on that. A frustrating thing that in the South African market is there is often a disconnect between the thinking and the alignment between the regulators. You've got the JSE self-regulation, you've got the PA and you've got FSCA, etc. So we sit in an environment, Aveshan mentioned earlier, that listed product, irrespective of what the wrapper is, if it's a note wrapper, if it's a fund wrapper, the listed product, by definition, gives you more transparency. There's the liquidity you can see, there's better investor protection, there's better regulatory mechanism, right? So for these risky or alternative assets, like crypto assets, you probably want another level of regulation. You probably want more transparency on that, because that's in the interest of the market and it's in the interest of investors. But now when I talk about the regulatory disconnect, is that any retail person can go through a so-called registered crypto asset service provider. They're so-called regulated. There is lots of them out there. Can go and buy crypto assets the FCA says it's a regulated environment, but it's an OTC environment. It's much less regulated than listed products. Now, I'm not saying it's the JSE's fault, because I know the JSE is pushing hard to get those products listed, but it's just the comments on the regulatory disconnect. It just doesn't make sense that you've got all these people running out and selling these products, but you can't have it in a more regulated environment. That's a big no-no. There's a strong policy statement from the FSA. Thou shall not list crypto assets in a regulated environment. But OTC, cowboy, let's go. That's all good, So my question then is, to what extent is the JSE as a self-regulatory organization, and I know you're involved in various platforms with National Treasury, FISCA, etc. To what extent are you making a contribution there and, pushing that narrative? Because, the OTC world shouldn't have happened before the listed world, because it's more systemic risk.
Well, I never thought anybody in this room would be asking for more regulation, so I am quite impressed, Ben, I must say.
I used to work for a regulator. So look, now, but to a lot of our clients, and in fact, I've got clients that's in the crypto space that actually want their products in a regulated environment.
Absolutely.
They prefer to have their Bitcoin and other crypto assets, and they've got some nice, crypto asset indices. They prefer to wrap that, into a node structure, into a thing, to have it listed. So it's not, there is understanding in the market that regulation is good,
yes.
And that's a role that the JSE plays.
So certainly, I would agree with you, and I think that the exact sentiment that you've expressed is the one that has prohibited institutions and banks and so on to actually get into this space, because there is that gap in regulation oversight and some of the existing offerings that are out there. So that is also been the trend internationally. I think all the big traditional players have not ventured to the extent that they might have wanted to, because the regulations and that safety zone has not quite been there. From our perspective, we obviously promote that very much. We think it makes enormous sense to bring that onto our regulated environments, to have the guardrails around that. I think the question that has been sort of holding up that debate amongst all regulatory groups for the past few years, throw in COVID and all these other things in the mix as well, is just what these assets are, what these underlyings actually are, and how do you control something that's intangible, that's driven by entities in other jurisdictions that are outside of your control. And it's really getting your head around something that is so different and so unique that I suppose has taken the time. But I will say that our regulator, I think, is very good at learning from others, and we have seen other very credible regulators, the Swiss, the Americans, many European regulators, the Singaporeans in the East as well. We have seen them making some good strides, and so I'm very confident that the conversations we're engaging in with the regulators are positive. We're trying to get somewhere. I think it's just, there's always caution, because the losses can be material if you take your eye off the ball.
Yes, but taking the eye off the ball, the losses is irrelevant, because you have assets that's more volatile than crypto assets currently listed on the Johannesburg Stock Exchange. You have, I have a client, you can look at the various ETFs that are actively managed ETFs, that is an actively managed portfolio it's an AI fund. Well, guess what's the correlation with the crypto assets in that AI fund? Like 90%. That thing is volatile. It's unbelievable. It's down 15%. Why? Because Bitcoin's down 15% from the highs. You know what I mean? So those products are already out there. That risk is already out there. So that speaks to the understanding. And it's look, I speak from frustration here at the moment because there's a lot of points, and I don't want to just sort of vent, but I mean, if you look at the tax issue on unit trusts, I mean, it comes from a complete lack of understanding what the impact is on the market. If you look at the current rumblings and unhappiness at National Treasury on the way it is actively managed ETFs, referencing foreign assets, it comes from a complete lack of understanding. I mean, the regulation is good. What the JSE is trying to do is good, and I'm encouraged to hear earlier that the JSE makes its voice known in those discussions, and we as an industry support that. Maybe to some extent as an industry, we probably want to get more involved in that. I know that's a controversial one.
No, not at all. I was actually going to raise, I think Leila mentioned it when she gave her opening address. There is a think tank working group, a body called Phumelela.
Yes.
It's led by a number of organizations in this room, big players in the financial services industry, who've put resources, their own resources, to work on a number of different proposals that will ultimately be handed over to the regulators and to the government, with the core objective to unblocking these things that you're talking about. The core objective of Phumelela and the work that we're doing there as a collective industry, as opposed to just one-sided from regulators, is to unlock mechanisms to make South African financial services more competitive, to create more of a financial hub here. So that, I think, speaks exactly to what your frustration might be, Ben, is how are we providing practical proposals, practical solutions to the regulator to say, we're the practitioners, we understand how things play out on the ground, let's actually work together to identify what the priorities should be and how one could practically implement them without sort of throwing out the baby with the bathwater, as it was. So I think we're all very optimistic around Phumelela. It started tail end of last year, and there are a couple of work streams dealing with a whole load of things. For example, I'm on one that we're looking at opening up the ability to settle in foreign currency and to take collateral in foreign currency and so on. And there's many others. So I think you have to watch that space and hopefully that chips away at some of that frustration and the speed with which we can actually get things done.
And it brings back to what Mr. Abel mentioned about us remaining competitive, right? What was it? The lipstick.
How do we put our lipstick on? Yeah, exactly.
Sure. Maybe we can move to you a bit, Ovation, and you can tell us in the product space, what sort of appetite are you seeing from clients and how we can work as a collective to, to satisfy clients' needs.
So I think, Alicia, you use the word regulation a lot, Ben. The word frustration. I think maybe a good word to use here is probably the most exciting one, which is the innovation side of things. And I think I will give credit to the JSE and even one of the local banks when, in 2004, I think the new gold ETF at the time was the third physically backed gold ETF in the world. And I think now it's obviously one of the most successful ones, but it demonstrates sort of the innovation that can take place in the market. And I think that's a good starting point. When we sort of look at what the demand for products or payoffs are now in sort of 2025, I think it's very much driven by the 2 points that the panelists have made on my left. Where there are regulatory frustrations, be it both in an exchange framework, in an OTC framework, even from a tax perspective, I think people are looking at ways to optimize those solutions. And I think that's really driven a bit of evolution to going beyond your vanilla asset classes in equities and fixed income and looking a little bit more in the alternative space. And that has a very sort of wide definition. So on our side, we're seeing everything from a variety of commodity requests, I think mutual funds or unit trusts being included in wrappers for various reasons, structured products being included in wrappers. So I think the investor base has evolved, and I think in that alternative bucket, and I think an important point here worth saying is it's not 80% of the client's portfolio. They've still got their traditional asset allocation. This is probably 5 to 20% that they'd like to allocate to something, is where they are looking, at some of these things. Crypto comes up almost weekly, I think, in discussions. Can we reference a crypto asset? Can we reference a company linked to the crypto ecosystem? So all these things, I think, are sort of on investor minds. Tax is probably the most pertinent one now, and I think with the sort of where the budget speech had landed last week, is probably very topical and on people's minds, and I think where that lands in 2 weeks' time will give us a steer on how people look at different solutions and what they can get from that.
Yeah, thank you. Thank you for that. Maybe let me just take a pause here and see if there's any question from the audience. No. Maybe, Ben, I can ask you one more question. What do you think are the reforms needed to attract the likes of the Vanguard, and the BlackRocks into our markets to list on the JSE?
Well, they're competitors. We don't want them, but look, I'm teasing on that one. I've had lots of discussions with Vanguard over the last years. Most recent discussion, in fact, was end of last year. To see if there's opportunity for them to bring their funds, into our market, and very interesting feedback. Being great market, because I've been chatting to them over the years, same answer as 5 years ago, hard no, we're not interested. What is the reason? Is we see much more appetite growth in markets like Israel, markets like Greece, markets like Turkey, And when you ask them why, and that speaks about product innovation that you touch on. It speaks on the framework is there's easier to do it there, and they've got much more liquidity there, And that's sort of like not good to hear, So I mean, the lipstick thing. I mean, we're always lagging behind the rest of the world, And there's no reason for that. I mean, Vanguard, BlackRock will list funds in South Africa if there's a reason to do so. But it takes like anything in the world. It takes resources, and you have to allocate people to focus on that. And I said, they'll focus their resources on the markets that I've just mentioned. So one has to work hard. And as I've mentioned earlier, the actively managed ETF platform that President launched, I think, plays a small role in that, to bring the more products, to bring the liquidity. I mean, the stockbrokers would know liquidity breeds its own liquidity, So we're probably not going to get massive liquidity from the equity side. So if a JSE looks itself as a trading platform, look, the primary reason for a stock exchange is capital raising, right? But if you look at stock exchanges worldwide, a lot of them sort of transformed to product platforms, right? That offer multiple products, not only equity, obviously the equity bonds, and that's sort of the obvious one, but structured products, ETFs, and that sort of. If you look at the trading volumes of ETFs worldwide, structured products, AMCs worldwide, it's massive. In some exchanges, it totally dwarfs the equity trading, So we want to see environments where product innovation is encouraged. Want to work together with the regulators to bring those products to market. That will bring liquidity. That will bring a more vibrant market. That will bring more issuers.
Also
and you have more
fulfilling.
issuers in a bigger universe. The bigger universe, it becomes the whole thing becomes self-fulfilling. And then just one thing I maybe want to add to that, from a market structure perspective, you would probably solve a lot of discussions we're having with the issuer regulation team. For instance, if you have a retail market and a qualified market on a JSE, which we don't have, right? Any product that's listed, a retail client can access it. So now, if a retail client can access it, the retail client's not as sophisticated, say, as a qualified investor. Now, in a London market, you have a qualified market and a normal sort of market. Now, if you have a qualified market, and I'm talking about the change in market structure, and that's maybe something you want to put in the thing that the JSE could look at, then you can have more weirds and wonderfuls, right, in the qualified market space as to, like, say, your vanilla ETFs on the other space. And that might help to solve a lot of these sort of like, friction in, to what extent you take regulation. Then you can even have like qualified hedge funds, for instance, listed qualified hedge funds in that qualified market. Yeah, so that is one suggestion from a market structure perspective that could be considered.
Yeah. Oh, I can see the flashing here, time's up. But thank you very much for the insightful discussion. If there's no other question, I think we can wrap it up.
Thanks.
Yeah.
Thank you.
Thank you.
Thank you.